Hi, JP. How you doing?
Good. How are you, Lewis, today?
I'm doing good. We were joking earlier before we got on here about what to talk about, and I'm looking at my text, and I'm not going to read the total thing that you said, but I think we kind of settled in on how to be selective in a market that's expensive.
Yeah, I think maybe we have to be a little more direct. I was looking at the leadership this morning, and I was starting to freak out a bit. So what's leading the market right now are companies that should scare all of us from they're great companies, like they're exciting companies, but when you look at the fundamentals, they make you cringe a little bit. And there is nothing wrong with this. You just have to know what you're paying for, right? I mean, let's use some example. I'm just looking at the list here. Shopify, love Shopify, great business model, fits right in, doesn't make money. Wayfair, again, great reason, great tailwind, doesn't make money. Teledoc, could not love it anymore. This, create all this doctor system, doesn't make any money, leading. Coupa Software, Twilio, Ring Central, Beyond Meat, those are all the leading companies in the
Leading over what time frame?
just today. Just like if you look at what's moving the market higher today as we begin this third quarter, those are not those. Those are great businesses that tend to. Again, it's a top line, right? When you look at what you're paying for top line. You're paying for sales, right? Those are companies that have innovation, that are, I guess, gaining market share, that are attracting, that are creating products that people want right now. But the market, what I'm worried is like to stay rational about how much you're paying for that business, because eventually a company has to make money to be worth something. That I feel very strongly about.
But historically, with those types of companies, when they are ahead of themselves like that, they'll move ahead if they really have something and they do turn profitable, and some of them will. Then what they'll do is they'll digest for a while once they turn profitable, and then if they continue on their profits, then they'll move forward. But that initial move up could be pretty significant from a trading perspective. From a long-term investment perspective, it may not. I mean, I'm thinking about what's the name of that company? Invisalign. When you look at Invisalign from when they went public, they had a massive move up. They were not making money, but they were real close to it, but they were growing their sales huge, not quite making money yet. And then as soon as they started making money, that thing went sideways for like a year. And then they continued to make money, and then the thing skyrocketed and went, and I don't know how many times it went, how many fold it went up, but a lot. So it just depends on that company. Ultimately, that initial run may or may not continue.
Exactly. And you got to find, like I said, some have great business model that are sustainable and will add value to investors. Others not. I mean, I don't want to say that I feel like it's 1999 again, but it's not completely unlike that. I think back then it was even more irrational. But
yeah,
what
it
I'm
was
saying
worse.
right
It was
now
about
is
eyeballs back then. It wasn't even sales. It was eyeballs.
exactly. Now we even had to create new metrics. I don't believe that we're there in any way, shape, or form. What I'm saying right now is it's time to be to keep our head on straight and do our homework to figure out what are we buying, what are we getting, and are we willing to pay those prices? I mean, you don't have. Let's take a more low to the ground business. Chipotle, right? We like our burritos, like the next people. They've done exceedingly well during the COVID crisis. But right now, you're paying 87 times trading earnings, 115 times forward earnings for Chipotle. That is more than double or triple the comps average. So, yes, they are better, but how much better, right? So it's always a
okay.
question.
I'm gonna push back just a tad, just because not pushback, but just brings up something. The data shows that some of the best performing stocks ever of all time have these huge multiples before they continue up. So I don't know how much weight I put into that, honestly, unless they're mature companies and their growth rates are not likely to be really high. And so I guess that's the real issue. Now, Chipotle probably is a good example because they're a little more mature than some of these other companies like Shopify.
Yeah, and I agree with you. I hate multiples, and I never use multiples that it don't mean anything, right? Unless you know what you're getting for it, right? And I totally agree. But those are still multiples that are super high. I mean, if at best Chipotle will grow at 10 to 15% over the next 3 years. We're not talking about a 30% grower, right? So that is a huge premium. When you're paying 20 times earnings and you're paying 6 times growth or some things, you still have huge amount of baked in expectations, and that's all it is, right? It's a question of we get paid and we make money about what is not priced in. And that's what I'm saying right now is we have to look at what's priced into those stocks and determine, do we believe that there is unexpected things that are not priced? And that's the one you want to find. That's how you make money, right? If you're on companies that have some of those drivers of growth that are not fully reflected in today's price.
Yeah, I know. It's the problem is actually figuring out what's fully priced in. I hear you. I hear you. It's a little scary out there if you're a value guy. If you're a value guy, you're going, oh my gosh, how none of this fits or very little of it fits my criteria. And of the stuff that is fitting my criteria, it is lagging dramatically. So like if you look and, I was just doing some things this morning. What I did was I took the Russell 3000 and then I created a trend barometer where basically what you do is you go and you say, okay, from that technical, we have this technical sharp factor that we have that gives us ranks. So, I put together a shorter term technical sharp factor, a longer term technical trend sharp factor. And then I looked at other things in terms of saying how close are they to the highs, and then got rid of the low price stocks, and got rid of the very low percentiles. And if you look at how many stocks are actually in that screen, it's only about 7% of the whole market is actually fitting good technical criteria from our perspective. I mean, it's a very small cream of the crop situation. And then I broke it down by sector. I was just kind of curious to see what the sectors looked like. And, from the total amount of companies, like I said, the representation, I looked at how much, what amount is represented in each sector. So for example, if basic materials has 102 companies in it, and, and what percentage of those basic material companies are actually meeting our criteria from a technical or a trend perspective, like a barometer. And then just compared that to the probability of them actually being in there at all, right? So are they represented more or less than the average stock in the market? And it's really interesting because you have sectors like healthcare, which is actually, if you look at it from the standpoint of saying, I'm looking at the indexes of healthcare, you would say that is one of the leading sectors, right? You would say healthcare has been strong. But then when you look at it, they're like one of the worst technically represented because many of the companies aren't doing well. There's just a tiny group that is doing well. And that tiny group tends to be larger cap, so that's making the index look better. So, and then you look at groups like communication services, and they have huge representation as a percent of the total sector. Real estate has huge representation. Financial services actually has better representation than other sectors, but the sector itself, from a market cap weighted basis, is one of the worst ones. So you know what I'm saying? So most people are looking at it going, oh, the financials are horrible. But when you look down deeper inside the technicals, you see a different picture. This is one of the things I like bottom up type work because, the kind of what we're talking about right now is being selective in an overpriced market. And, I think that's the whole concept. You can use that same philosophy bottom up from a fundamental or technical perspective. But when you start diving in, I still think there's lots of opportunities out there.
Yeah, no, I agree with you. And I think that framework makes sense because right now, we're not going to make a forecast as to what kind of market we're in, but we're seeing a tremendous amount of rotation in sector leadership. So bottom up seems to be the name of the game right now. So looking at where are the pockets of things that look good either, and we generate ideas, like you said, both from a technical attractiveness perspective and also on the fundamental side. So we kind of hopefully bring the two disciplines together and find out, well, who are those companies that look good? Are they all concentrated in one space? or are they, and we try to build, of course, diversified portfolios, both from a sector perspective and from a, I guess, style, if you want to call that perspective. Like we talked about those companies that are on a momentum, and we will own those companies, from time to time. We just want to be careful about maybe having an over exposure to that kind of companies, which if something goes wrong, like let's say those are priced to perfection with tremendous amount of expectations, when the market hits a blip, those will roll over, chances are, if there is no fundamental to support it. In the long run, hopefully the two will confirm each other. So yeah, I totally agree with that. And we've proven that over the long run, the factors that you mentioned, we back tested those back over multiple cycles, and it does add value and give you a better risk-adjusted portfolio, meaning that you get better return for the amount of risk that you take. And we're seeing that
it's pretty dramatically different too.
Very dramatically.
It's funny how, I mean, this is the thing that blows me away all the time, because I'm a fundamental guy too. And we always joke behind scenes, say, Louis, you need to turn in your CFA, your Chartered Financial Analyst, because you just turn it in, right? And because I'm also a chartered market technician, right? So, but the thing is that the factors for technicals are actually more robust on the data that I've looked at, and that's really hard to swallow, because everything that we learned from day one in financial, learning is saying, we need to go and look at these fundamentals, and they do matter long run. So it's not like you don't want to ignore them, for sure. And we know that those stocks that don't have the fundamentals, when things blow up, they're the first ones to pop really hard. They're just going to absolutely implode, I should say. But like right now, if you look at the short term, what's interesting is most stocks are actually below they're in long-term downtrends still. I should say intermediate term downtrends. And what I mean by that is, if you look at just the 50-day moving average versus the 200-day moving average, most stocks in the market are still below the 200-day moving average. Those two have not crossed positive, even though we had a big move up, right? Because we had a big move down, big move up, but most stocks have not actually turned positive trend on an intermediate term basis. But if you look at it on a short-term basis, if you compare like the 20-day exponential moving average versus the 50-day exponential moving average, you get a total different picture. You get a bar graph for each sector showing all of them positive except for one, and that's energy, right? And the strongest one, I call it TSR, technical Sharpe ratio. The strongest technical Sharpe ratio on a short-term basis right now is technology. Then it would be consumer cyclicals. And then you would have, believe it or not, industrials, which has a lot of different companies in it. Actually, it's pretty broad. They're really technically on a short-term basis saying, hey, we've turned the corner in this economy, right? And we've been talking about this. Now, the question is that real? I think that's the biggest fear right now, because we see these COVID figures increasing. And then there's this fear like, hey, maybe the market is not pricing this thing right. What do you say to that?
I mean, that's what you're seeing, right? There's still a number of scenarios that are possible. And I think what you're seeing is in the market on a daily basis is the percentage or the credibility of which scenario is being played out. So we were playing the more rosy scenario so far, and we've seen that early rotation last month into recovery type of sectors and type of companies. That's how, industrial started showing some signs of leadership and the likes. We've seen in the past week kind of a, maybe a more cautious stance that, okay, maybe there is more risk than we thought, and more, we should be more cautious. So you've seen, again, a pullback of those early, leadership and back into some of the more conservative stance. So I think the market is a tug of war right now on this on these various scenarios, and the outcome are vastly different, right? In some sectors, the impact of changing your outlook on things are significant and massive, right? What would make the difference between again, that old V shape we hear about all these letters about a V shape, very short-term lived versus a more sustained recovery. And again, I always go back to my fundamentals. I mean, making those change in assumptions in the value of stocks gives you a very different present value of what's attractive and what looks good right now in the market, I think. And I think we're seeing that on a daily basis playing out in the market.
I agree. Financials is a prime example. I mean, and I'm in the minority here. I like U.S. Bank. I like those companies right now. I think they're priced very well. And yes, we have some short-term problems, but if you look at their like enterprise value, what they're really worth longer term, I think they're great investments right now. And I would like to own more of them, but the market's not rewarding us for that. So I mean, I think there's a lot of examples of that.
Yeah, and that's what you're seeing right now. I open with this kind of rant on companies that don't make money, but clearly the market is rewarding those are stay-at-home theme, companies that, Amazon's still on the leading today. It seems to be that at least today again, and on the leadership, those remain very strong on an overall basis. So there's a lot of continuity in those thematics there. And sometimes
the chips are big too. I mean, the chips have been actually the technicals indicated the chips should be bought several months ago, and now the fundamentals are starting to come out. The components. I mean, you see those electronic components. That stuff is still very healthy. There's still a lot of great tailwind into call it 5G, and there's generations of. You're right. It's the components, not just the chips. I mean, it's really components, and that trend will continue regardless whether we stay home or not.
That's correct. I mean, those are massive shift in technology that, there's a lot of money behind it, a lot of CapEx being spent in some of these new innovation. And those
I worry
really,
about
honestly,
Facebook.
Doesn't change.
I worry about Facebook because, they're basically an advertising company. I mean, we use Facebook as well, right? So, I mean, and, traditionally advertising companies, those are the most cyclical companies on the planet.
Yeah, and we haven't seen it. This is probably the first, call it the acid test for the advertisers. That's Google and that's Facebook who live on advertising. There is still a tremendous amount of shift in advertising dollars being shifted from traditional media to internet, and that has masked. I think if you look back to 2008, 2009, that has the gain in market share of Google and Facebook from dollar amount mask any kind of slowdown in ad spending. Now there is some headline saying that corporations will slow down a little bit on ad. Also, the effectiveness of online ads has been questioned. So I think people are going to be a little more cautious about spending dollars. Facebook is under pressure from a lot of other reasons that has put pause. I mean, I've heard of a lot of advertisers, big and small, pulling back their spend with Facebook just from a just cautious stance because of some of the positions
for other reasons.
that Zuckerberg has taken. So yeah.
But hold on a second, hold on just a second, because you used a lot of financial jargon, and that's cool. You and I use that all the time. But like for the average person, I mean, if I can summarize that basically is saying that they've been getting a bunch of business from the traditional advertisers, and because they've been getting that business, that's offset the fact that advertising dollars in general as a total has slowed in terms of growth. And so the question is how long does that stay in its position? And I don't mean to single out Facebook. I mean, but I'm using that as an example of how fundamentals can change things. And you know what? Ultimately, those start showing up. First and foremost, they'll show up in the price. Then they'll show up in the quarterly earnings reports. And that's kind of the sequence of events normally in the market. It'll come up. Actually, it's more like price, then estimates, earnings estimates, then reported. That's usually the trend, the sequence of events. So price is leading the estimates, and estimates are leading the fundamentals. Now, on a longer term basis, the fundamentals, if they get out of whack severely, if price is severely below measures of value, then over a longer period of time, there tends to be a catch up. But it's not a trading tool. Value is not a trading tool, period. It's not. I mean, the data does not support that from what I've seen. I wish I could find a trading tool on value, but I can't. So far, I haven't been. Somebody please, let us know if you found it and just tell me when you found it, because I would love to be able to say we have a trading tool based on value.
Yeah, no, it is not a timing tool by any means. You can be wrong a long time on the value side. That's correct.
But it tells you what's coming.
Yeah.
Yeah, it tells you you think it might be coming. And that's really interesting. Well, selectivity, man. It's it, right? Selectivity and diversification. Really
exactly.
important.
Don't be. It is not throwing a dart at the wall. And I'm going to go back to. I'm not saying things are getting frothy, but definitely, I think there's a general money flow into the market, into some of the same names, with maybe a little more on faith than actual rigor of analysis, and really having a good thesis to why you own, a reason why you own those stocks. And I think it's just time to being cautious. I mean, the market is rocking and we want to be in, but we know how that party ended back in whatever cycles, whether it's I heard yesterday, like, oh, it was the best quarter since 1987. When 87 didn't end very well, right? Same thing if it feels like 1999, 2000, that didn't end very well. So I'm not predicting anything, but I'm just saying let's go back to solid. As long as you have a process, and like we do, like we participate in those names, and when the market tells us otherwise, we'll get out, and we have a long list of ideas that we find will look good, and then we're hopefully going to be in the right areas of the market that are.
I still am more optimistic right now than I've ever been in my career. Honestly, I am, because of what's going on underneath all this. We got all this stuff coming at us, and that's bad. And usually things that happen bad, they happen like in sequence, but more than one time. It happens over and over and over again. Like 5 things happen bad at once, and they come in clumps, and then they'll go away. And but if you look at the underlying underneath it, we've got this great, huge millennial wave that's coming. Smart people who are technologically savvy. We've got, as long as we don't kill the goose that lays the golden eggs, which is free market capitalism. Sorry, in my opinion. I should say it's entrepreneurial capitalism. As long as we don't kill that, I'm super, super bullish, because that means we're going to be continuing to innovate. We've got the groundwork we've got fast speeds, and we've got all sorts of new things that are happening. And so to me, that's just great. My biggest concern, honestly, if you were to say, what would turn you to say, I just don't like the market in general, or I'm not bullish on equities, it would be if we actually get so regulated, or so we kill the entrepreneurial capitalist thing that really makes our economy work. And I'm not being political, because just to be full disclosure, when I vote, some are R and some are D. Okay, that's how I work. I go issue by issue, background by background. So what I'm saying is, we've got to keep that entrepreneurial capitalism going in order for me to stay bullish. I don't want to be too political.
Yeah. And I'll take a different perspective on that. And I agree with you. My long-term view is bullish. The U.S. market is not going to go away. We're going to keep growing earnings. What I'm looking for right now, we have the seed, like you said, of a lot of great things that are going to take us to the next level. And we're in the midst of
may not be the case.
Yeah,
right?
the information, the information revolution right now, right? So we have AI, we have great innovation in robotics and automations and things that are going to propel productivity. I mean, we haven't seen a gain in productivity since the internet, essentially. We've had the PC, we had the internet, now we're looking for the next thing. And I think some of these technologies, biogenetics and all these things will
but it's going to displace people when that happens.
Oh,
it always does.
It's going to be coming at a great unrest, like everything. We're going to survive that. We're going to adjust. People will have to be retrained, and great jobs will be lost. And traditional companies maybe will lose market share, will lose sales, as others will become great. I mean, we've seen it in brick and mortar, with the Amazons of the world. We've seen it over and over again. I can, whether you're old enough to remember going to Blockbusters versus streaming on Netflix. I mean, those are signs of those shifts, but they will make us better. They will make us more efficient from a productivity standpoint, and that's what we need to see to take this economy to the next level. So there will be a catalyst to do this. But then we see those those times sometimes take like, a decade to digest and to get to the next level. We've had, very good bull
I don't think we're in
markets,
that though. You know why? Because we had that. We had the
Yeah.
peak of March of 2000, and we had 11 years of nada.
Correct. I'm saying
50% down, 50,
we've
50,
seen
50.
it. We have seen it.
We have seen it, and now we're heading, in my opinion, we're heading into a new bull, secular bull, and right now we got a short-term unrest, and the unrest that we have is there's a lot of valid concerns, but I think eventually what's going to happen is America is going to wake up and they're going to go, listen, we're all in this together. This person doesn't lives matter, but no, all these lives matter, all these problems, right? But we're going to say we're in this together and we can solve these problems. I think that's what's going to happen. Now, if we have some downside in the meantime, that's normal. That happens too, right? It happened. I grew up in the South Side of Chicago. There was riots where I lived, so I know it firsthand. And most people, I don't think can say that, like have been that close to it. So I know. I mean, it's ugly, but that's just a small symptom of the short-term problems that we have. But I do think it's fixable. As long as we at some point look at each other and say, look, we're all human beings and we're in this together, let's solve it, then that's when things get better, in my opinion.
No, that's great. Parting words. I think it is going to come back together, and I hope we do. Certainly do.
Yeah. So anyway, not to be so serious, but anyhow, just that's really interesting what you said about the valuation. It's good that we brought it up again, and you're right. There's concern there. There's definitely concern, and but we just keep our process, and it all works out. So anyway, JP, always good talking to you. Is there anything else that you want to say parting wise?
No, I think there's a lot of things we can share with you. But if you hopefully if you do it yourself, maybe we put words of cautions as well as optimism into everything, as well as. But if you're looking for for help, make sure that you understand the process and the reason why you invest and you own what you own. Again, know what you own and why you own it.
That's great that you mentioned that, because it reminds me that we were talking at our weekly meeting that one of the things that we're considering putting out there is a special portfolio analysis thing that we're going to just let people have for free. You say, look, if you want a second opinion on what's going on based on objective data, we can give you this analysis on your portfolio. We have all the technology to do this, and we'll give it to you for free so that you can get a second opinion about what you're doing. The idea is to help people, so that's something that we have on our docket. That hopefully we can come up with something in the next quarter that would be really good for people. So, JP, thank you so much, dude. As always, my finance bud for 2 decades.
Good. We'll offset each other. I'll keep. I'm not a bear, but I keep things real. So
yeah, you keep things. Yeah. Well, we both kind of that. We've always been that way.
Yeah,
like this, because which is good because we get closer to the truth. I think when you have that dialogue, and that applies to lots of things. So,
great.
So I guess that's it for now, guys. Good seeing you. We'll talk to you soon.
Have a great day.
Bye.